There's a single phone call to HMRC that, for around 2 million UK couples, would put a cheque worth up to £1,260 in their account, and then save them another £252 every year for the rest of their married life. It takes about 10 minutes, it costs nothing, and the couples most likely to qualify and most likely to be missing out are retired ones. It's called the Marriage Allowance. It's been around since 2015. HMRC's own figures suggest that over 2 million eligible couples have never claimed it. If you're married or in a civil partnership, and one of you pays basic rate income tax while the other doesn't pay any tax at all, there is almost certainly money waiting for you. Whether you worked your whole life and retired, or stopped working early to look after grandchildren, or never went back to full-time work after children, or simply have a small private pension on top of your state pension, the chances are high that you, specifically, are one of the 2 million. Stay with me because two things decide whether the claim is worth the maximum or only part of it. The first is the full benefit rule. There's a specific income range where transferring your allowance actually gives back less than you'd expect. Knowing the line means knowing whether to apply now or wait. The second is a separate, much more generous allowance for older couples. One that catches a particular group of married people out every year because they apply for the wrong one. Okay, basics. The marriage allowance is a tax relief for married couples and civil partners. Cohabiting couples, even those who've lived together for 40 years, do not qualify. You have to be legally married or in a civil partnership. The way it works is straightforward. The non-taxpayer in the couple, the partner whose income is below the personal allowance of £12,570 a year, transfers some of their unused tax-free allowance to the other partner. Specifically, they transfer £1,260 of personal allowance. The other partner, the basic rate taxpayer, now has a higher personal allowance and so pays less tax. At the basic rate of 20%, the saving works out at £252 a year. That's the headline figure, £252 in your pocket every tax year, just because you're married and one of you doesn't earn enough to pay tax. Now here's the part that makes this powerful for retired couples. The full new state pension for the 2026 to 2027 tax year is £12,547.60. The personal allowance is £12,570. The difference between those two numbers is just £22. So someone whose entire income is the full new state pension and nothing else is technically a non-taxpayer by £22. If their spouse has any income on top of their state pension, a small private pension, a workplace pension, any part-time earnings, rental income, they almost certainly tip into being a basic rate taxpayer because the full state pension on its own is £12,500 and the higher rate threshold doesn't kick in until £50,270. In other words, the classic UK retired couple, with one having only their state pension and the other with something else on top, is exactly the situation marriage allowance was designed for. And yet, retirement tax guides consistently report that retired couples are the single largest group missing out on this. It's worth understanding why. The most common reason? Many retired people assume tax breaks have to be claimed against earnings, wages from a job. They don't. Pension income counts the same as earned income for this purpose. The state pension counts. Private pensions count. So does income from rentals and savings interest, although those have their own rules. So if you're a retired couple, apply. Let me make this real with the example used in published retirement guidance. A couple called Margaret and George. Margaret retired early to care for grandchildren, and her only income is the full new state pension, £12,547.60 a year. That's just under the personal allowance. So Margaret is a non-taxpayer. George worked until he was 67. He has his state pension, plus a defined benefit pension worth around £20,000 a year. His total income is roughly £32,500. That's well into the basic rate tax band, but nowhere near the higher rate threshold of £50,270. So Margaret can transfer £1,260 of her personal allowance to George. George's effective personal allowance goes up from $12,570 to $13,830. That extra slice of his income that would otherwise have been taxed at 20% is now tax-free. The result, George saves £252 in tax for the year, but because they hadn't claimed in the previous 4 years either, they can backdate. A successful claim made in 2026/27 can also cover the 4 tax years before it: 2022/23, 2023/24, 2024/25, and 2025/26. Each of those years can pay up to £252 in a backdated refund. Add it all up, 4 backdated years at £252 each, plus this year at the same bang, and they're looking at a total benefit of £1,260. About £1,000 of that comes as a single check or bank transfer shortly after the application is approved. That single phone call to apply was worth over £1,000. Now, the first open loop I planted, the full benefit rule. This is slightly counterintuitive, so listen carefully. To get the full £252 of saving, the non-taxpayer ideally needs to earn no more than £11,310 in the tax year. Why? Because when you transfer the £1,260 of allowance to your partner, your own personal allowance drops by exactly that amount. It goes from $12,570 down to $11,310. If your income is below $11,310, you don't notice. You weren't using all of your allowance anyway. The transfer is a pure gain. The household is £252 better off. But, and this is the catch, if your income is between $11,310 and the full personal allowance of $12,570, you might end up paying a small amount of tax yourself that you weren't paying before. That small tax bill offsets some of the gain on the other side. Most retired couples don't run into this badly. If one of you has only the full state pension, £12,548, you're inside the awkward zone, but you're still meaningfully ahead because your partner's saving exceeds your small extra tax bill. But it's worth doing the maths before applying. HMRC has a free marriage allowance calculator at gov.uk. Search Marriage Allowance Calculator, and it does the comparison for you in less than a minute. A couple of other rules worth knowing. The non-taxpayer must be the one to apply, not the higher earner. This catches people out. The higher earner often tries to apply, thinking they're the one getting the saving, and it doesn't work. Whoever is below the personal allowance has to make the application. Both partners must have been born on or after the 6th of April, 1935. If either of you was born before then, there's a more generous allowance available, which I'll come to in a moment. Neither partner can be a higher rate or additional rate taxpayer. If either of you earns more than £50,270 in England, Wales, or Northern Ireland, or above the Scottish intermediate rate threshold of £43,662, you can't qualify. Right, how to apply? The cleanest way is online at gov.uk/marriage-allowance. Search Marriage Allowance Apply on gov.uk and you'll find the right page. The lower earner applies, not the higher earner. You'll need both your own and your partner's national insurance numbers and 2 acceptable forms of identification for yourself. If you want to apply for the current year and backdate up to 4 years in one go, do it by post using a form called the Marriage Allowance Transfer Claim Form, or MATC TCF. You can download it from gov.uk. Many retirement tax guides recommend doing it this way for backdated claims because the post route handles all 5 years, current and backdated, in a single application. If you'd rather speak to someone, HMRC's General Inquiries line is 0300 200 3300. Lines are open Monday to Friday, 8 in the morning to 6 in the evening. Once you're approved, the saving works 2 ways. The current year's benefit comes through as an adjustment to the recipient's tax code. Their code gets an M suffix for Marriage Allowance recipient. The lower earner's tax code gets an N suffix. The backdated refund, if you've claimed for previous years, arrives as a separate check or bank transfer from HMRC. That usually lands within a few weeks of the application being processed. And once you've made the application, it rolls over automatically each year. You don't have to reapply unless your circumstances change. Now the second open loop, the more generous allowance. If either of you was born before the 6th of April 1935, which today, in 2026, means you'd have to be 91 or over, you may qualify for something called the Married Couples Allowance instead of Marriage Allowance. Despite the similar name, this is a much more generous tax relief. The Married Couples Allowance can reduce a couple's tax bill by somewhere between £453 and £1,170 a year, depending on your income. If you or your partner were born before April 1935, and there are still hundreds of thousands of people in the UK in this group, do not apply for the standard marriage allowance. Apply for the Married Couples Allowance instead. You can do that through the same HMRC tax helpline, 0300 200 3300. A few special cases worth mentioning. If your partner has died, you can still claim marriage allowance, backdated up to 4 tax years, ending in the year of their death. Call the HMRC number with their details to hand. Their record remains accessible for this purpose. If either of your circumstances change, for example, the higher earner moves into the higher rate tax band, or you separate or divorce, you must cancel. If you don't cancel, HMRC can eventually reclaim the overpaid allowance, which is a process you really don't want to navigate. To cancel, call HMRC on the same number or use your personal tax account online. One quick protection before we close, because tax refund scams are extremely common. The real HMRC will never text you, will never email you, asking for your bank details or asking you to claim your refund by clicking a link. Genuine marriage allowance refunds arrive by check or bank transfer only after you have applied. They are never offered to you out of the blue. If you get a text or email claiming to be HMRC offering you a refund, forward the text to 7726 or forward the email to phishing@hmrc.gov.uk. Delete the original. Never click the link. So, 2 things to do today. First, if you're married or in a civil partnership and one of you doesn't pay tax and the other does, apply. The online application takes about 10 minutes. If you've been eligible for the previous years and never claimed, do the postal claim for the backdated 4 years at the same time. A successful application could put over £1,000 in your account by Christmas. Second, if you have parents in retirement or grandparents, ask them whether they've ever heard of this. For most retired couples, the answer is no. Today, you could be the one who tells them. Now, there's a quieter conversation we should have about something that doesn't sit in benefits, doesn't sit in tax allowances, and isn't paid out by HMRC or the DWP at all. It sits in your national insurance record. Most people don't know they can check it. Most people don't know they can fix it. But there is a single check on gov.uk that can reveal whether your future state pension is going to be paid in full or whether there are quiet gaps in your contributions that, if left unfilled, could quietly cost you thousands of pounds over the course of your retirement. That's the next video. The state pension gap check that almost nobody does, and how to find out whether you're owed pension money in the future before the chance to fix it slips away. Subscribe so it lands in front of you, because every April these rules change, and the people who stay informed are the ones who don't get left behind. This channel is for general information only. We are not affiliated with HMRC, the DWP, or any government body, and nothing here is personal financial advice. All figures are current at the time of recording and can change daily, so always confirm your own situation at gov.uk or with a free advisor such as Citizens Advice or Age UK.